Okay, so today I really want us to make progress by way of looking at the remaining 4 transactions we have to see, namely the expense, the income, return inwards, return outwards, and then drawings, 5 of them, I should say. And then after that, we'll solve a question and then proceed to balancing account. Sorry, balancing account and writing the trial balance. But I'm sure probably because of our timing, we may not be able to do the trial balance, but we should be able to finish balancing of the account. So without wasting my time, let me pick 1 or 2 comments from you. If there's something you want to tell me, then I can proceed. So just 5 seconds. If you have anything to tell me, go ahead. Okay, 5 seconds is up. Nothing for me. So the remaining transactions, as I've indicated to you, payment of expense, receipt of income, return inwards, return outwards, and drawings by the owner. But that being said, let me quickly take us back to the things we have discussed so far. Investment by the owner, buying an asset, sale of goods, purchase of goods, acquiring a loan, settling a liability. Good. So payment of expense. Before we look at it, we need to know what an expense is. So I want one of you to read what you see for expense here for me. Yes, Prof. Alexia. I think it's been long I heard your voice. So can you read for us?
Payment of expenses. Okay. Expenses are costs incurred in running a business to generate profit. Okay. Technically, it refers to decrease in the financial resource of a business associated with sale of goods and services to customers. Expenses decreases the profit of a business, which ultimately decreases the capital or owner's equity. Examples of expenses to businesses are rent, wages, salaries, maintenance, discounts allowed, bad debt, electricity, insurance, etc.
Okay, thank you there.
Paying expense.
Thank you very much. Pause for me there. Good. So, ladies and gentlemen, the point is that expenses are also costs or they are payment. But these kinds of payment refer to, decrease in the financial resource of a business associated with the sale of goods and services to customers. So the business incurs this cost for making the effort to sell goods to its customers or render services to the customers, right? And so we say that if this happens, because it's a cost, it is going to affect the business capital by way of it's going to decrease the profit and ultimately decrease the capital. And I think I showed you that in the extended version of the accounting equation, that expenses will decrease the capital. So if you are solving questions and you see payment of any expense, then the ultimate effect will be that there will be a decrease in capital and a corresponding decrease in an asset because you are going to pay the expense with asset, cash, or bank, right? So let me move on by saying that paying expenses reduce asset, cash, or bank, which is check, when you use check to pay the expense, and also decrease capital. What is the double entry? If an asset is being, what do you call it? If capital is decreasing, then we have to debit capital, right? But here, we will not debit capital account, we will debit the expense account to show the decrease in capital. Remember, we said when capital decreases, it is debited. And if expenses will decrease capital, you have to debit the expense. The corresponding entry will be a credit in the cash or bank account because that cash or bank will decrease or reduce. And if an asset is decreasing, the credit. So the summary is that anytime you see payment of an expense, which could be rent, wages, maintenance, salaries, etc., you have to debit the expense account and you credit the cash or bank account. So I have some examples here for us. Paid motor expense by cash. So the business paid an expense, which is motor expense related to motor vehicle. So we open motor vehicle expense account and we open cash account. We'll debit motor vehicle expense and then we'll credit cash. In terms of the effect, this motor expense will decrease capital and also decrease asset cash. Okay. So can I move on? Any question on the expenses? Good, no question. So let's move on to receipt of an income. So I think Prof. Alexia will, or let me call Prof. Bishop. Prof. Bishop, can you read the income or receipt of income for us?
Yes, sir. Yes, please.
Yeah, go ahead.
Receipt of an income. Income are revenues earned by a business in its operations. Technically, it refers to increase in the financial resource of a business resulting from the sale of goods and services to customers. It increases the profit of business, which ultimately increases the capital of owners' equity. Examples of income of businesses are rent received, commission received, investment income, and dividends, etc. Receiving income increases assets, into brackets, cash or check, and increases capital. The double entries are debit the assets, cash or bank, and credit the income account. Even though income increases capital in the accounting equation, an income account should be opened to record the income by crediting the income account.
Okay, thank you very much, Prof. Bishop. So you see this directly opposite to the expense, right? The expense is the cost you incur for selling goods or providing services. Income, on the other hand, is revenues received or earned for selling goods or rendering services. So anytime a business sells goods, right, and gets a return or a revenue, that is an income. So for example, sales is an income. When you sell goods, the sales amount you receive is an income, right? It could also be another form of, revenue or gains resulting from operations of the business. For example, if a business Bishop invest in treasury bills. So let's say Prof. Bishop is into buying and selling of shoes and the business has gotten some money. So he goes to GCB and buys treasury bill, which is a form of investment, or maybe even do fixed deposit for which the bank will pay interest. That interest is an income to the business, as in the business is receiving some form of inflows, right? Okay, so examples of them include rent received, commission received, investment income, as I've explained, and then dividend. Now, dividends are also form of returns on investment, but specifically when you invest in a company. Okay, when you invest in a company, you are referred to as a shareholder of that company. And for that matter, you receive dividends. So you can note that somewhere. Dividends are returns received by shareholders of a company, right? I want to believe you have been taken through the forms of business ownerships where you have sole proprietorship, partnership, and companies. So when you invest in a company, you are referred to as a shareholder, and anything you receive from the company as income is dividend. Good. So we are saying when you receive money, you see the thing is money, you are receiving money. So your cash or bank, depending on the means through which you receive it, will increase, right? And we have also learned from the extended version of the accounting equation that income increases capital, right? So anytime you see receipt of income, it means capital will increase, and then asset, cash, and bank would also increase. The opposite is for expense. For expenses, the asset will decrease as well as capital will also decrease. So you can note these summaries. So example here is commission of 350 received by check. So we have received a commission by check. So our bank asset bank will increase. So we debit bank account and we credit commission. Why are we crediting commission? Because from the summaries, we saw that when income increases, okay, we credit it. Or better still, because the income will increase capital, when capital increase, we credit it. But here we credit in the name of the income. Okay, so that is for receipt of income. Please, if you have questions, draw my attention and let me. The next things we want to look at are return outwards and return inwards, which are also opposite to each other. Return outwards of goods and return inwards of goods. But let's pick the return outwards. Prof. Richmond, can you do the reading for us this time? Hello, Prof. Richmond. Yeah. Yeah, we can hear you. Go ahead.
Return outwards, also known as purchase returns, Return outwards, also known as purchase returns, refers to the amount of goods returned to a supplier, creditor, by the supplier or creditor by the business.
Okay.
It decreases an asset as a stock of goods. Hence, a return outward account is opened and credited, and it also decreases liability, bracket creditor. So the creditor's account is debited.
Thank you, Prof. Richmond. So, my lady and gentlemen, when you hear return outwards, please, it simply means that a business has returned goods to the supplier or creditor. You know, a business mainly deals with suppliers and customers. Suppliers are those who give goods to the business, right? So, for example, if business Alexia is Indomie Indomie manufacturing company or whatsoever, if I want to put it that way. If she goes to Malcolm to buy the packs of Indomie, then Malcolm is a supplier to Business Alexia because Business Alexia gets the goods from Malcolm, right? So if due to some reasons, Business Alexia would have to return some of the goods to Malcolm due to maybe the goods had expired or maybe the business required for 10 packs, but Malcolm has supplied 15, then the business would have to return the 5 back to the supplier, Malcolm, right? So that is return outwards, when goods are returned back to suppliers. And some of the reasons why this can happen is, number one, the goods may, if the goods have expired, the business will definitely return it, or they are faulty, or there was oversupply of the goods. Okay. Now, if you analyze it, you see it is goods that we are returning back to the supplier. So it is going to reduce our goods, which is the stock. That is why we say that it decreases the asset stock. And if asset stock is decreasing, we need to do a credit entry. But that credit entry will be in the return outwards account. Now, the other side is, as you return the goods to the supplier or creditor, it will decrease the liability you have with that creditor. So going back to the example I gave, if business Alessia went to Melcom to buy 10 packs of Indomie at, say, 100 cedis, and for that matter is owing Melcom 100 cedis, and then she returns, or the business returns some back to Melcom, let's say 20 cedis back to Melcom, then the liability or the creditor's account will decrease from 100 to 80 because we have returned back 20, right? That is why we are saying return outwards will decrease the creditor's account, and for that matter, decrease the liability. So in terms of the double entry, you are going to debit the creditor because a liability is decreasing, so you debit, and you credit return outwards account. So credit return outwards, debit the creditor in this case. Good. The opposite is return inwards. So return inwards, yes. Before we read, can you share your opinion? If it's the opposite of return outwards, what do you think will be return inwards? Whoever is ready can give me his or her opinion. Oh, this one is simple now. The clue is there. Return outwards is when the business returns goods to suppliers. So return inwards, what would it be? Yes, Prof. Richmond.
This is a situation whereby the supplier returns the goods back to them.
Okay, so Prof. Richmond says the supplier this time will return the goods to the business. That's a fair attempt and a good attempt. But let me pick opinion from Alexia and Bishop. Who would go first? Ladies first. So Prof. Alexia.
Sir.
Yeah, go ahead.
Yes, I think return inwards is refers to the goods returned to the business entity when customers find that the goods delivered do not meet their expectations.
Okay, so Prof. Alexia is bringing in a different dimension from Prof. Richmond. In her case, it refers to the amount of goods that customers are returning back to the business. Okay. Prof. Bishop, where do you belong to? Do you belong to the school of thought as per Prof. Alexia or as per Prof. Richmond? Or you are an independent candidate?
Yes. So for my was is when the company or the organization
Okay, I think Prof. Bishop.
since the
Yeah, Prof, you have to come again. Your network was breaking, so come again.
So please, I think the return inwards is when the business gives its goods to the customer.
Okay, when the business give the goods to who?
The customers,
Okay.
the buyers.
Okay. So now I am the electoral commissioner. I need to tell who has won the election. Okay, so candidate Richmond and candidate Bishop, I think we have to give applause to candidate Alexia because she gave the yours were a bit closer but not the exact. So return inwards means that the goods are being returned to the business by customers, right? The opposite of return outward, which is the business returning the goods to a supplier. Yes, I can see Bishop applauding Professor Alexia. That's great. Okay, so in the case of return invoice, it refers to the amount of goods that customers of the business return back to the business. Okay, so if you use yourself as a business, return invoice means that your customers are returning goods to you. And then return outwards is you, the business, returning the goods to your suppliers. So you have to use the customer and the supplier to differentiate between the return inwards and return outwards. Okay. So look at it. What will even happen for customers to return goods back to the business? It means that in the first place, the business would have made sales to the customers. So we say another name for return inwards is sales returns. Okay, when the business sells goods to customers and then they return some due to reasons like maybe the goods are faulty or expired, or maybe the business oversupplied the customers. So here, let's look at the scenarios. If we sold, let's say, 20 pence to customers and they return 5 back to us, what is going to happen? The 5 they are returning back to us will increase the goods that we have. And as well, will decrease how much the customers owe the business. So I love using examples because that in a way makes us understand the concept very well. So for instance, Omega Financial Accounting business, we sell 50 pence to customers, right? Maybe we had 60 pence and we have sold 50 in the Akaten. Now, if the customers return 5 of the 50 we sold to them, you see that the 5 will come back to the business to add on to the remaining 10 we had to 15. So it's going to increase the stock. And stock is an asset. So if an asset is increasing, we have to debit. But what account do you debit? You debit return invoice account. And the corresponding credit entry will go to the customers or the debtors account. Why? Because that asset is going to decrease. So when we sell 50 to them and they are supposed to pay us 50 cedis and they return 5 to us, it means the price or how much they owe us will reduce from 50 to 45. So that is how come the debtors balance will also decrease. And for that matter, you credit the debtor. So when return invoice happens, debit return invoice, credit the customer or the debtor. Whilst in return outwards, you will credit return outwards and debit the supplier or creditor. So take note of that. Any confusion on that? Okay, no confusion. So let's pick our last transaction. That's drawings by the proprietor or the owner. Drawings by the proprietor or the owner. Okay, let me do this quickly. When we say drawings, it simply means that the owner of the business is taking something away from the business. What could that thing be? It could be cash, it could be money in the bank, or it could be the goods. Sometimes it could even be expense. But in the case of an expense, it means that the owner is adding his or her private expenses to the expense of the business. So imagine you are doing a business. Let's say you have rented a kiosk shop in the market. So that is the business rent. If you come and add your private chamber and hall rent to that of the kiosk rent and say that is the rent of the business, that is very bad because you have your private home. You don't have to bring that expenses to that of the business. Okay. So that is drawings for you. It could be cash. So the owner can take cash out of the business for maybe to go and chop some birthday or weekend. Or you can even take some of the goods. So if Prof Bishop is selling shoes, you can take some of the shoes and wear it. Right? So since it's for personal use, we term it as drawings. So drawings refer to withdrawals made from the business by the proprietor or the owner of the business for his or her personal use. The owner may withdraw cash, check, or stock, or any other assets from the business for personal use. If this happens, we say that drawings decrease the capital. It only makes sense because if you have invested in the business as capital and you are taking something away, then your capital will decrease. So drawings will decrease capital. And if capital is decreasing, we all agree that you have to debit it. But what account are you going to debit? The drawings account. Okay. Now the corresponding credit entry will go to that particular asset the owner withdrew. So if it is cash, then we are going to credit cash because cash will decrease. If it is check, we'll credit bank. If it is stock, pay attention. If it is stock, we are going to credit purchases because we don't have stock account, right? We are going to credit purchases. Why are we crediting purchases? Because purchases keeps the stock that we have as a business or the stocks we buy as a business. So if the owner is taking stock, we have to credit purchases. Okay. So that is it for drawings by the owner. So anytime the owner makes drawings, debit drawings, credit either cash, bank, or purchases in the case of stock. So I think we come to the end of the basic transactions that we need to go through. Any question? No question for me? Okay. Gentlemen, you don't have a question? In that case, I think we have a few minutes for the first session to end. So when it ends, we'll rejoin the second session and continue there and probably look at solving some illustrations, right? Okay, so this session, I think, is ending and we are wrapping up with the drawings which we have just discussed as when the owner takes something or withdraws a resource from the business for his or her personal use. Thank you. Any question? I'm waiting for questions.